We've got the latest research on target date funds, plus we'll also do a discussion about commodities. What are some of the factors that are sort of driving what's going on in the commodity world these days? So those topics, plus, of course, as we get into this first segment, that's where we talk about the week that was, headlines, market activity, things like that. And certainly we've got a few things to talk about this week on the program. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Certainly, we want to say a special hello to our listeners on our radio show network that is heard Sunday mornings here live on 96.9 The Game. We've been on the sports channel called The Game for a couple years now here on this time slot. And so we wanted to certainly take a moment and recognize that it's a big day for listeners of The Game over there at 96.9 FM, 740 AM, of course, because you have the Buccaneers playoff game coming up a little bit later on this afternoon, kickoff at 3 o'clock. We are, in fact, if you follow us on YouTube, we're wearing our Patriots tie. Sorry, I don't have any Buck stuff, but you know, Tom Brady's probably going to go into the Hall of Fame as a Patriot, not a Buccaneer. Anyway, so we've got the tie on in recognition of a big game coming up in Tampa today. So I'm sure our listeners at 96.9 The Game are very excited about that. So, of course, we've got to talk about the week that was. Certainly, I think in a lot of ways it was a good thing that the week itself was only a 4-day week. Let's not forget that the markets were in fact closed this past Monday because of the Martin Luther King holiday. So only 4 days to the market, if you will, and I think in a lot of respects that was probably a good thing, right? Because it was not a particularly good week for the markets. The worst week in the market since back in the year 2020, which when you think about it isn't that long ago, but it does sort of underscore one of the things that we've been talking about on this program is that last year was a very smooth year. And that's not normal. It's actually more normal to kind of have some volatility during the course of any given calendar year in the markets. Well, certainly you saw some volatility last week. For the week, the Dow was down about 4.5%, which of course is a measure of 30 companies. The S&P 500, a little bit broader, 500 different companies, although there's a handful of companies that sort of drive the performance there. That index was down about 5.5% for the week. And then the NASDAQ, which is perhaps a little bit more broader, a number of different companies. There are thousands of companies that go into making up that particular market index of the NASDAQ. That for the week was down about 7.5%. From its peak. NASDAQ is now down about 14%. So you've got a lot going on in the market. Certainly, past couple of weeks, we've been talking a little bit about NASDAQ, that particular market index, and noting that there's a lot of companies in that index that have gone down quite a bit. And what was interesting is due to the performance of Apple and Microsoft, the index itself, in terms of that value that you see splashed on the TV or on the internet, seemed to be kind of hanging in as a result of really those two companies. We'll see how the week ahead progresses because Apple, for example, is on tap to announce its earnings. And so what's happening is we're in the middle of earnings season. Certainly earnings for the fourth quarter of last year coming in okay, but it's what these companies are saying about the road ahead that is difficult. And certainly when you think about the fact that now there's not that easy money flowing from DC, right? So they're not just completely throwing excess cash into the system through various stimulus packages. At the same point in time, the Federal Reserve is also in the process of increasing interest rates. There's speculation that those interest rate increases could happen now as early as March. And if you've been listening to this program on a regular basis, you know it's been sort of this journey of the Federal Reserve just completely changing its message about when it's going to raise interest rates. And we've talked a lot about that on previous episodes, but the reality is that they keep changing the timeline in terms of when interest rates increases are going to happen. We suspect that those could actually start happening as early as March. So those are the things that are laying sort of on the market, if you will. Toss in, to a certain extent, a little bit of the COVID factor, Ukraine. I mean, definitely got some headlines out there. I think, though, the COVID thing is kind of interesting because perhaps maybe we're all just getting tired of it, or just maybe not having, thinking that it's going to have as much of an impact economically or drive the fortunes of certain companies, because certainly those sort of more attractive companies that did well in COVID, we're thinking like Peloton or Netflix, they had a particularly rough week. Peloton for the week was down about 14%. Netflix was down about 24%. So some pretty significant declines, particularly among individual companies that were favored during the COVID times. And not to say that we're not still in COVID times, but perhaps it's just becoming a fact of life. And so consequently, those companies that saw their share price appreciate sort of due to that, everybody staying home and needing to rent movies or needing to go on exercise bikes, that in and of itself has become less and less. Interestingly, also Bitcoin, a cryptocurrency, which if you listen to the program, you know that we are generally not particularly big fans of, also really participating in this notion of, as the easy money comes off the table, as the interest rates get higher, things like that, then some of these more speculative items wind up getting hit disproportionately. And if you're tracking the price of Bitcoin, that in fact is down about 46% since November. So in less than 3 months, you've seen a 46% decline in crypto, particularly looking at Bitcoin, which of course is the largest cryptocurrency and the most well-known. So a lot going on out there, particularly in the more speculative areas of the market. And again, I think that's a representation of that easy money coming off the table, higher interest rates, things like that, things that were bound to happen. At some point, the folks in Washington, the Federal Reserve, put a lot of monetary stimulus into the economy to perhaps get through the COVID period of time. The problem is that it may in fact wind up being too much. So anyway, what are 3 takeaways that investors need to know as it relates to what's going on in the market this past week? We've got 3 specific takeaways talking about what went on in the market this past week, but we've got to take a break. So when we come back from the break, we're going to give our listeners those 3 key takeaways for investors thinking about what went on in the markets this past week. So stay tuned for that, and we'll be back after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the 3 takeaways that investors should have after the week that was in the market. Certainly a rough week if you were following the market, even though it was a 4-day week with the Martin Luther King holiday there on Monday. It certainly was not a pleasant one for equity investors. The overall market's down anywhere from 5 to 7%, depending upon what index you were looking at. And so certainly that's representative of perhaps this realization that 3 things are happening out there. First and foremost, the easy money out of Washington may in fact be coming to an end. No more stimulus money, despite conversations about trying to get another round of that. The appetite just does not seem to be there, combined with the fact then that you've got the Federal Reserve that is in the process of raising interest rates. I think it's very clear. They've already said they're going to raise them at least 3 times this year, perhaps maybe even more, to combat some of this jump in the inflation numbers. And then lastly, with COVID itself, certainly that is still out there, but I think more and more people are just kind of taking it as a fact of life more than anything. And so consequently, you're seeing the companies that sort of did well during those periods of time, or that experienced a heightened demand for their products and services, maybe not having the same level of demand that they had a year ago when everybody was sort of locked down into their homes. So what does that mean for investors? Well, we've got three things that investors need to be aware of, particularly after last week. Number one, market volatility is in fact quite normal. If you look at the history of the market going back over the past 100 years, you're going to see that volatility is a normal part of that upward trend of the markets. That's why it's hard to be an investor consistently and over time, is because you have these periods of time where the market goes down. That's part of it. And it's a normal part of the market. But because last year was an incredibly smooth year, we didn't really have much volatility throughout last year. And you could even go back to March of 2020, a year and a half plus, where there wasn't a whole lot of volatility in the market. So people forget that, oh, wait, this is a normal part of the process. So remember, normal volatility, market volatility is normal. May have forgotten that it was, considering the smooth ride over the past 18 months. I think maybe a lot of investors did. That's particularly true when you see odd asset classes like your cryptos going up through the roof. People think, oh, it's just going to keep going up and up and up, and I'm never going to have to reconcile risk in this picture. Yeah, it doesn't happen that way. So number one, market volatility is normal. Number two, and certainly something we've said before on the program, volatility loves company. Volatility loves company. Once you have volatility in the markets, it doesn't just simply instantaneously go away. It usually sticks around for a few weeks. So what that means is that there's probably some more of this. So buckle up for the bumpy ride, but make sure that you maintain that longer term perspective. Just because you've got volatility a few weeks here and there doesn't mean that the next 20 years or 30 years are not going to play out to your benefit in terms of your investment approach and retirement planning. That's the perspective you've got to maintain. Not what's going on this week, but what you expect to occur over the course of the next 5 years, 10 years, 20 years. Because remember, while you may be going into retirement today, that doesn't mean that your life is ending. It simply means that there's a whole nother 20 odd years where your money has got to be doing what it needs to do in order to generate return, in order to generate income to help you pay your bills. So, but beware, volatility loves company. Number three, if you're regular listeners of this program, you know that we've been talking a lot over the course of perhaps really, I think back probably the past year, about this notion of rebalancing. In fact, I know it's been over a year because when we sent out our January letter to our clients, and that was in the mail last week, we talked about the fact that last January's letter talked about volatility, expecting volatility and how normal that is for the markets, and the fact is that we hadn't had much of it. Well, fast forward a year later, wasn't much volatility either, but at some point that volatility comes in. So that's certainly one of the things that we've been talking about, and how to deal with that or how to address that. Well, that gets the importance of rebalancing. And certainly when you think about rebalancing, what does that mean? Well, it involves looking at the mix of stocks versus bonds, and then it involves looking at the types of companies that you own. Are they large companies? Or are they small companies? Are they growth companies, tech companies, or are they more value or dividend paying companies? So it's important when you, as an investor, to look at that mix of companies that you own and that ratio of stocks to bonds, obviously bonds being more conservative, stocks being less so, but a rate of return trade-off, if you will, on stocks versus bonds. And so to take a look at that and do that kind of a rebalance on a regular basis, certainly something that we've been talking a lot about on this program over the course of the past year. So hopefully you did that. Hopefully you rebalanced, reduced down the stock, went a little bit more into bonds because of the appreciation in the market, maybe trimmed out of the growth, went more to value, dividend paying side of things. Because if you look at that difference right now that's playing out in the market, the value or dividend paying companies are having a tendency to stay up a little bit more, not go down as much as some of these more growth-oriented companies. So those are certainly the three takeaways. Number one, normal, market volatility normal. Number two, volatility loves company, so don't think that all of this is just going to magically disappear. It's usually around for a few weeks. And then number three, rebalance, rebalance, rebalance. We've certainly talked about that a lot. If you've done that, then you should be able to just sit and enjoy the football games this afternoon without having to look at your investment portfolio. If you're rebalancing your investment portfolio along the way, then you should be able to weather whatever the storm is that may happen over the course of the next few weeks, months, or years. So that's the takeaway for investors. In a sign of the times, not sure if you saw this, but certainly if you are a member of the Florida retirement system, you probably got a letter here a few weeks back, and I guess it is sort of the sign of the times. It is from the Florida retirement system. It went to all members of the investment plan. So remember, in the Florida retirement system, there are two different things, right? There's the pension plan and the investment plan. So this had to deal with a notification for FRS members in the investment plan of, in fact, a data incident. Apparently, a security incident at a third-party mailing vendor involving personal information. The good news is that apparently there wasn't a misuse of personal information. Bad news is that this is just a part of life, right? This is a part of reality. I think by now, pretty much everybody has gotten these kinds of letters, whether it's a security breach with your credit card company, your phone company, your retirement system company. It is a pandemic in terms of, or endemic across this country, that these are the kinds of letters that happen. What happened here with the Florida retirement system is a company called Quantum Color Graphics, a vendor for Alight Solutions, who happens to be the FRS investment plan administrator, whose role as a printing company was to print out and mail the statements to FRS investment plan participants, had an incident that resulted in an intruder posting a set of Quantum's files online. So that is what happened. That's, like, unfortunately the course of action. The information on those statements included names, addresses, allocations, all of that. Did not include social security numbers, and it was as a result of a software vulnerability that has since been remedied. Again, the good news here is that they're not aware of any misuse of information, but they are offering you that free service of credit monitoring. And shoot, if it's free, maybe that's something that you as an FRS investment plan member might want to take advantage of. So be aware that that has happened, and it's part of life, but certainly you get the option to be able to take advantage of a credit monitoring service. Anyway, we're going to slide to the break. When we come back, we will return here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. Hopefully you caught that last segment of the program. We're talking about the letter that Florida Retirement System investment plan members received over the course of the past few weeks. Again, a sign of the times, another letter that details a data breach that happened. In this particular case, it involved the printer that was printing out the statements that were being sent out to FRS investment plan members. So just be aware that that happened. You certainly may want to take advantage of the free service that they are offering for credit monitoring. Very typical in today's world when that happens. That's sort of what folks get offered as a way to keep track of their information in the event of a data breach like this. So certainly something that all state employees who are members of the FRS investment plan need to be aware of. Hopefully folks saw that letter. One of the things that we recommend to people to do is, if you have been a victim of fraud, we encourage you to do a fraud alert on your record. You can do that simply by calling any one of the 3 credit reporting agencies, and they will take care of that. You do need to call back and redo that every, I think it's 9 months if I recall correctly. But that means then that there is a little bit harder process for a company to, or a fraudster to open up accounts in your names and things like that. So that's always a good option if you find yourself, maybe not in this particular case because the data was general in nature and there was no incident of misuse, but if there is an incident of misuse, one of the things you can do is a fraud alert. Fraud alert, a little bit easier to work with than a freeze. A freeze really kind of locks things down pretty good. So typically the alert is a good way to go in terms of trying to combat this stuff, which unfortunately is a normal part of society that we live in today. So anyway, welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars and in some cases your identity. But of course, if you have identity theft issues, then that can certainly affect your dollars pretty quickly. Anyway, my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. We're wearing the Patriots tie today because, as our listeners on the game know, 96.9 FM, 740 AM, this afternoon, of course, a Bucs playoff game. So exciting stuff for football fans out there. Certainly the games yesterday were 2 very exciting games as well. We hope that, frankly, the Bucs game is less exciting and it's a nice, easy win. Time will tell, of course, on that. Anyway, shifting gears back to financial stuff. Didn't know if you saw this one. There's been some additional research on target date funds that continues to confirm. The more this research comes out on these target date funds, which really have become all the rage over the course of the past decade, the more the research that comes out on this, it just sort of confirms what we've been saying for years on this program, is that they become all the rage, but perhaps they're not as this great one solution fits all as most folks perceive them to be. Started in the late 90s, so they've been around a little while, but they've become very popular over the course of the past decade. They were intended to give investors sort of simpler choices on your 401k, traditionally your employer-provided retirement plan platform. It was intended for 2 purposes, right? To give limited choice, to give simpler choices, but also to reduce down the liability on the employer side, because then folks were directed into these target date funds based upon their birthday, and then ultimately those target date funds wound up shifting more conservatively as that date approached. So it was intended to be quote unquote simpler, but there was also some reduction of liability that was being sought by employers as it related to them providing retirement plans to their employees. Well, since then, they have exploded in terms of the number of dollars that are in them. Approximately 40 million Americans own these types of funds. Total assets in these funds, over $1.6 trillion. The problem is, simpler isn't always better. And certainly that's been our contention on the program, particularly with this concept of putting your retirement on a glide path. That's how these target date funds are sort of set up, is they're going to glide you through your working years and glide you right on into retirement. So what that means then, at say 40, you're 90% in the stock market, and then that 90%, the exposure to the stock market, decreases to about 50% when you get close to your retirement age, and then as you get further into your retirement age, typically decreases to less than 30% or more in terms of the allocation to the stock side. So that's kind of the glide path, right? More stocks when you're younger, less so when you're at retirement age or into retirement. And that sort of underscores the issue, is that our contention has always been that they glide too conservatively, too early in one's age. Certainly the latest research confirms that as well. So this research, courtesy of the National Bureau of Economic Research, studied by a bunch of MIT guys, things like that, the primary conclusion, and here's the thing, remember, 40 million Americans own these funds. It's a total of 1.6 trillion in them. The primary conclusion is that the typical glide path used by target date funds is too conservative, starting at about age 50. Well, I don't need to be an MIT professor to know that. That's something we've been talking about on this program for years, is that these funds get too conservative too early. The notion that you've got 50% by retirement age in only 50% at retirement age in the stock market, and less than 30% or so once you're into retirement, just is not appropriate. The study concluded, again, a bunch of MIT guys, things like that, the study concluded that at all ages, the recommended equity exposure to not go below 60% for optimal performance over time through all market cycles. Let me say that again. The optimal level, not to go below 60%. Folks, that's a balanced portfolio. 60% stock, 40% bonds. I mean, that's a classic conservative growth and income kind of portfolio. Why does a portfolio still need growth? Because people are living longer. And inflation, which is in fact a part of life, and now we've all been reacquainted with it, haven't maybe had it for the past 10 years, but if you look at the history, it's been there. So having a portion that is on the equity side makes sense. When you look at the research, it actually is saying don't go below 60. So that's a pretty interesting take, because a lot of target date funds do that. That's a significant shift in the whole target date mindset, that at the end of the day, that research really goes directly to confirming what that investment asset allocation. Study also concludes some other factors to consider when it comes to equity allocation. Wealth. The wealthier you are, the more you can afford to take risks, so you don't have to go as lighter on the equity side. Of course, I guess that's another way of saying the rich get richer at the end of the day. Where you are in the business cycle, but more importantly, as an investor, you need to watch out for these target date funds that will glide you right into an allocation that is too conservative for what it needs to be. The research is conclusive on this. If you don't believe me on it, listen to the guys from MIT that did the research. Stay away from those target date funds, or change the date so far forward that you don't glide right out of the market and right into a too conservative investment allocation. We're going to take a break. When we come back, we're going to continue the conversation here on Dollars and Cents with Joel Garris of Nelson Financial Planning. One last addition on that conversation about target date funds. Very clear. Should be no discussion now about those funds, which have become all the rage, so popular. 1.6 trillion in them. 40 million Americans own them. The research is conclusive. Those funds glide much more quickly than they should to a more conservative mix than what investors need to have. So if you own one of those funds then what you've got to do is look at other investment options that might hopefully be provided to you in your employer retirement plan. The reality is that a lot of those employer plans have really shrunk down the available investment options, really all going to these target date funds. These one size fits all, reduces employer risk and liability associated with that performance. That's really a part of why these funds came into existence. So let's get that on the table as well as to who they were really created to help benefit. Investors on one hand, but employers on the other in terms of risk management. So if you've got those funds in your employer plan, what you need to do is you need to go out much further than you think. So if you're thinking, oh, I'm going to retire in the year 2030, probably be wise to go out to 2035 or 2040 in order to not have that allocation glide too quickly into the conservative side of things. Again, the study courtesy of the National Bureau of Economic Research, a bunch of MIT guys, said, hey, these glide paths, you really shouldn't be gliding below 60% in terms of the equity exposure in a investment portfolio. So be aware of that and what that ultimately means. Here's another thing that also is coming out, and it actually was detailed in an article in yesterday's Wall Street Journal, that these funds can in fact generate some pretty significant tax implications. And so remember, these funds were predominantly designed to be inside of a retirement account. So that means that because of the internal selling that happens in these funds, particularly when they get to certain points in times where they've got to sell out the stock piece of the portfolio and shift it into bonds, well, then that stock piece of the portfolio that they're selling out to glide that into a more bond orientation is going to create some tax implications, particularly if it's a fund that's been around for a while. You've got internal capital gains on the stock piece on those portfolios. So it's all fine if it's in a retirement account because you don't really see that because it all just gets reinvested. And when you take the money out, it's still ordinary income. But if you own these funds outside of a retirement account, then you're going to have some tax implications that you may not have really bargained for. And so if you look at two of the biggest Vanguard target date funds out there, the 2035, the 2040, both of those funds had capital gain distributions that were equal to 15% of the value of those funds. So if you've got 100 grand in those funds, that's a $15,000 reportable tax bill that you've got to put on your tax return for 2021. So understand also then that these funds, again, designed for retirement account, if you own them outside of it, there's also some issues in terms of how they work from a tax perspective and how much of a burden that can put on you from a tax perspective. So beware of these target date funds, particularly if you read the article from yesterday's Wall Street Journal, if you own them outside of your retirement account. So some important research and data on target date funds as well. So we welcome our listeners into the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. If you missed any part of the program or want to hear it again, know that, of course, we have this as a podcast on a variety of podcast channels such as Spotify, iTunes. Also have a video of this program as well on YouTube, where you get to see me wearing the Patriots tie today because, I don't have any Bucs stuff, but, Tom Brady used to play for the Patriots, now he plays for the Bucs. Anyway, so we got exciting NFL games this afternoon, so hence we're wearing our Patriots tie. But you can't see that if you're just listening to the podcast, so if you subscribe to us on YouTube, then you get to see that as well. Anyway, certainly an opportunity to subscribe and listen to the program. If you have problems locating our channel on any of those platforms, just go to our website, Nelson Financial Planning, nelsonfinancialplanning.com, and you can look in the upper right-hand corner, click on the icon that looks most familiar to you, and you will get instantaneously connected over to our platforms on whatever icon you clicked on, and certainly subscribe to us so you know when we upload these programs. We typically do it in the beginning of the week, so it winds up being up there. So one other thing that we wanted to add about the discussion about the letter that folks in the Florida Retirement System investment plan got. Obviously, there was a data breach there, very similar to all of the other data breaches that have happened over the course of the past many years and will continue to happen because that's just unfortunately, the world that we live in now. There is a free credit monitoring service that is being offered to you as a result of that data breach incident. Understand, though, that there's also a deadline on when you can elect to take advantage of that service. And we did not mention that early in the program. Here's the deadline. It is, in fact, the end of March. So by March 31, if you want to take advantage of the benefit, the credit monitoring, along with a bunch of other services, if you read the letter, we've got a copy of the letter. It winds up being credit monitoring, internet surveillance, identity restoration, it includes $1 million identity theft insurance, things like that. So certainly, and it's a 12-month Experian Identity Works membership. But in order to take advantage of that, you must elect to do that by March 31 of this year. So that's certainly something that as a state employee, and again, this impacted state employees that were in the investment plan, to really take advantage of that opportunity to get this free credit monitoring service. Obviously, if someone's offering it to you free, it certainly makes sense to try and to take advantage of that. So that was the other addendum that we wanted to do on the Florida Retirement System investment plan notification of data incident that folks would have gotten a few weeks ago. Probably 3 or 4 weeks ago is when that came on in. So anyway, we had planned on talking a little bit about commodities this week, but unfortunately we are running out of time. So what that means is that we will table that for next week's program, a full discussion about commodities, what's going on in the commodities market, what's driving commodities, and what are some of the main forces behind it. Got some interesting stuff on that across the board that investors need to be aware of. So those are the numbers. We got the dogs barking in the background to sign us off, so we're going to sign on off and hope everyone enjoys the beautiful Sunday out there. A little bit cooler, but hey, that's okay. Beautiful day indeed. With that, we will wrap it on up and get on out of here. Thanks for listening to Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.